Hello, Veena.
Yeah.
Right, good. Yes, I'm doing very well. Today it's a holiday for us because it's our Independence Day. So,
Wow.
yeah, good holiday also. So, but being a Saturday, it's normally it's a holiday, but again a special holiday. So it's good.
Huh? Oh, okay. Good,
Right,
good, good.
right. Yeah. So, after today, we have about 3 days little gap. So what I think we must do, you must do during this period is now we have done
Hmm.
about, I think about 9, 10 mocks, I think. You must start
Hmm.
again writing, rewriting the mocks,
Hmm.
the answers. Right.
Okay.
That time try to do it with the next 2, 3 days. If you find time, try to send me some answers and we
Hmm.
will go through that one because we have covered up a fair amount of areas. So we should be able to now look at most of the questions fresh again.
Okay.
Right. So today let's continue with our long-term finance a little bit
Hmm.
because we were on the subject of uh, rights issues. I think this is the most appropriate way this company can probably go future. But you remember yesterday we discussed couple of things. We can think of the maintain distribution going public, listing and getting some money. We
Yes.
can think of for all the films approach it, venture capital companies to get money.
Hmm.
We can always think of bank loans, all that is all right, but we saw the gearing is fairly on the high side,
Hi.
40 or some percent. And the
Yes.
other way is that for last couple of years, I think for 2 years, we see they have not gone for a share issue or something like that. It is to go for
Hmm.
a share issue in our main company, the main team.
Right.
So Maintain, if they are going for a share issue, so there are 3 ways we can issue shares. One is the initial public offering. Second
Hmm.
one is what we call a rights issue. That is where we have done the initial public offering. We can do a rights issue. Third one is actually, it's not the third one, actually it should be the first one, what we call placement. Placement.
Okay.
What is
Hmm.
placement? In your idea, what is placement, Veena?
Um, I guess that is something called private equity.
Yeah, it's more than, remember we discussed private equity also yesterday. Private
Hmm.
equity is generally given for companies which are already listed. For them to get delisted, they can go for a private equity partner.
Hmm.
But this is, yeah, in a way, it's like private equity. You know what happens here is before a company goes public,
Hmm.
strategically what they decide is they try to invite few good investors with some
Hmm.
name, some reputation kind of a people to buy shares in the company before the initial public offering, right?
Hmm.
So what happens is, there is no price as such, but they will negotiate a price, a predetermined price, but you get some good people into your shareholder portfolio. So if you're
Right.
thinking of
Yeah.
a strategical, if you're thinking of a going initial public offering in December 2017, it may be a good thing for you to approach some good quality investors and get them onto your shareholder portfolio in February 2017. And with
Right.
that
Yeah.
kind of a strength, when you go in December for a
Hmm.
share issue, you can always say so and so is also a shareholder of our company. That is going
Hmm.
to enhance the profile of the company, and that probably will
Hmm.
give you a better share price.
Right.
So that's the idea. It's one of the most cheapest way to get money. You don't need to
Hmm.
go for a you don't need to go for an initial public offering at all. You can always go for private placement.
Hmm.
The idea is when you go that one, because you are not advertising to small scale, so you spot the investors. I mean, you may not know, but your investment bankers, advisors, they know who are the people who are having money, who are interested in this kind of shares.
Hmm.
So they
Right.
will approach those people and they will say that, Mintin is interested and this is the price, that kind of a thing, and they will get some people. So by doing that one, later on, if you want, you can go for an initial. So the sequence is normally placement, initial public offering, then after that, rights issues. So particularly Mintin distributors, if you are thinking of going for a listing, it may be a good thing for you to go for a placement today, somewhere early, get some good people like the people in the film industry kind of people to be the investors. They are generally rich people who are good investors. You get them on the board and then the people will realize, these people are in the board. So that means, they don't need to be in the board of directors, but they are shareholders. Right? And when you have that kind of shareholders, the others will have naturally the confidence more to invest in your company.
Right.
That's the idea. So that's what we call a placement. So placement is the most cheapest way to get money because you don't go for mass scale advertising. You don't need to put prospectus and all that. Just a couple of telephone calls here and there. You get some big investors coming. That's the cheapest way to get money. The only disadvantage of getting a placement is you don't have the shares are spread amongst few hands. So the marketability of the shares is a factor. Right? Because some big people are holding shares, they may not want to sell the shares. So then once you go for a public offering, after that, when it comes for the marketing, there is no very active market when it's a rights issue, when it's a placement. That can happen.
Right.
So that's the only disadvantage. Second cheapest way is the rights issue because you don't go to the entire market. You go to the existing shareholders only. That's the second one. The most expensive way to go for a share issue is the initial public offering because being the initial public offering, you have to go through lot of processes, procedures. The company need to be advertised, promoted, all that means lot of money to be spent on the share issue expenses.
Right. Yeah.
After the initial public offering, one way you can go for another public offer without going for a rights issue is if you can get the consent of all the existing shareholders and they agree that no need of a rights issue, you can go to the public market, you can go for a public issue again.
Okay.
Right? The idea is once you buy shares, now for example, let's assume that in this particular company in Mintin, let's assume that they have 800,000 or something like that, if I remember, 800 million. Let's assume that the shares are let's assume the shares of 10 pounds or something like $10. $10 shares, and let's assume they have 80 million shares.
Right.
Just give me a minute. Yeah. So this is your present share capital, 800 million, right? And now the company wants to raise some money and company decides to go without a rights issue, company decides to go for a complete new public issue. Now let's assume out of this 80 million shares, 80 million shares, Veena, you are a rich lady, you are holding 8 million shares in this company. So that means you have a 10% holding.
Right.
Right. Now the company, without inviting you, the company goes to the public market and issue another. Let's assume that another 20 million shares by issuing. Now what will be the total share capital? It will be 80 plus 20, 100 million.
100 million. Yeah.
100 million. Now out of 100 million, you are holding 8 million. Right? Because you did not buy shares, you are holding 8 million. So what has happened to your percentage holding? The percentage holding has come down. Right? It has come down. So your not necessarily a control in interest, but your interest in the company has come down because the company went straight away to the share market and issued shares. And by doing that one, what they have done is they are deprived of your pre-emption rights. Pre-emption rights. So that's you had originally you had a 10% interest. Now it has come down because now you're holding 8 million in a 10 million in a 100 million company. That is what has happened, right? So to prevent this solely, the law says if you are coming out for issue, you must come out with what we call a rights issue.
Okay.
When a rights issue happens, what happens? Let's assume that it is going to be a rights issue now. So what happens when it's a rights issue? Now they have 80 million shares.
Yeah.
10 million shares. Now they want to issue another 20 million shares. So if you look at the ratio for 80 over 20, so for every 4 shares that you have, they will offer 1 extra share. 1 share.
Right.
Right. Now if they come out, right at the moment you have 10 million shares. Sorry, I said you have 8 million shares here.
Right.
8 million shares. Now what they will do is they are going to increase the share capital by another 20 million. 20 million. When they increase, what is going to happen is you who had 8 million shares will buy for every 4 shares 1 share, and that means you will also buy another 2 million shares.
Right.
What is happening to your interest? The company has total 100 million shares. You have 10 million shares. So your 10% that interest is definitely
right.
Understand? Now, if they have gone and issued the 20 million without inviting you, your interest in the company is down. But the moment they invite you and if you buy, then of course your rights are protected. This is what a rights issue is all about. The idea of a rights issue is to keep your rights protected. The only way they can do without going for a rights issue is with the consent of all the shareholders, they can go and issue. Now, when they come out with the rights issue, as I said, the present market price may be $15. They might offer it if they offer it at $15, there is no particular interest for you to buy. Because you can buy it at any moment, you can buy it at $15. The market price is 15, then you can buy it. But if they say they are going to offer it at $12, then you have a great attraction, every reason why you should buy these 2 million shares, isn't it?
Yes, it does,
Right? Because it come in at a discount for you. You are getting some kind of a blessing. You are getting some kind of a privilege which the others are. That's what we call a rights. So you can buy it at a cheaper rate than what the others are buying. Of course, now you earlier had 8 million shares. They are offering now, so that is why they have to ration it. So that is why they take the proportion. Okay, 80 new, 80 old, 20 new, 80 divided by 20 is 4. So they say for every 4 old shares, the company will issue 1 new share.
1 new share.
Otherwise, what will happen is Veena having a lot of money, Veena will think of not buying 2 million shares, Veena will be thinking of buying 4 million shares. And if they do that one, some other person will be deprived of again their rights. So they have to ration it. So by rationing it, that is what they do, and this is what we call the terms of rights issue. They will give it at a discounted price, but a rationed amount. Now, even though it's a rationed amount, right, Veena is entitled for 2 million shares at the rate of say 12 into 2 million, you need 24 million money. Maybe at that time you are not having money.
Okay.
Right? You are not having money. So, in that case, the company has offered you, you could not buy it. Now, that's not company's baby. Company offered you to buy, you could not buy it. Now, what will happen is, your 2 million shares, which you did not buy, some other person will buy. Company has the right to go and give it to some other person. When that some other person buys, still again the same old story will happen. It is 10 million, 100 million new shares, but you only have 8 million. But that is your own undoing because you did not have enough money to buy, but the company offered it.
Right.
So that you can't prevent it. So that can happen. So when you are offered shares, the 2 million shares, you have a couple of options. One thing just to ignore, you are not having any money and you will say, you will not buy. The company needs your 2 million money. Company needs 24 million. They will go to another person and buy it. Or if there is no one buying, the underwriter will come and buy it. You will lose your controlling interest or the interest in the company, the rights, but that's what happens. Another thing what you can do is you can, because it's coming at a discounted price for you, you don't have money, but you can sell those rights. Right? That particular benefit what you are going to get, you may be able to sell it to another person. I'm interested in buying that 2 million shares, but I can't buy it at 12, right? I have to buy it at a higher price in the market. But you might say, okay, Kumar, give me $1 extra, right? The benefit is let's assume for the moment the benefit is $3, 15 and 12. It's not so, but for the moment let's assume it is 15 is the benefit, 15 is the real price, 12 is your price. So you will say, Kumar, okay, you give me $1. You will keep that in your pocket and you will transfer your right to buy the shares to me. So I can pay to the company $12 and pay $1 to you. Still, I will be also profiting because if I had to buy it in the market, let's assume it is going to be 15, but now I can buy it at 12 by paying to the company and by paying $1 to you.
Right.
So that's another way. That is, you are transferring your rights. If you don't transfer your rights, either way, you will lose your interest in the company. But if you buy the shares, you will be maintaining your interest in the company.
Okay.
So these are the possible things that can happen in a rights issue. And these are the questions that they might ask you in a situation like this.
Okay.
So talking about the rights issue, this is where new shares offered to the existing right to buy new shares ahead of outside investors is known as preemption rights. So some question may come up. One of your directors might ask, hey, Veena, what is this preemption rights they are talking about? Can we issue shares without, ignoring the preemption rights? No. The purpose of preemption right is to ensure shareholders have an opportunity to prevent their stake being diluted by the new issue. Preemption rights can be are protected by law, can only be waived with the consent of the shareholders.
Right.
So rights issues are far cheaper than a public issue because you don't go to all the shareholders, all the entire market, you go only to your existing shareholders, but surely much more expensive than a placing. Placing, you go to a few number of people and you try to collect your money. Now I want to look at something very important with you about the rights issue price. So whenever the company wants to issue rights, we will have to issue obviously at a price below the market price. So generally, as a rule, about 20% below the market price. If the shares are going at 15, you might decide to issue it at about 12, just below the market price. Right? In theory, no upper limit to issue the price because, you can issue it at any price, but all depends. If you try to make it very high, people may not be very attracted. In theory, no lower price, but you can never issue below the nominal value of a share. That's a law. But it all depends, now let's assume you want to raise in that company 24 million. Now, if you are going to issue 24 million at 12, you need to issue only 200 million shares, 20 million shares, right? But if you want to get the 24 million and 240 million, and if you are looking at issuing at 11, you have to issue more number of shares. Right? So if you give a bigger discount, the number of shares that has to be issued will be much more.
Yeah.
So it all depends at what price. So to strike a balance, you should not be giving too much of a discount. If you give too much of a discount, you have to issue too many shares. When you issue too many shares to the market, what happens, Veena? When there are too many shares in the market, what happens?
Again, the same thing. It would dilute the ownership.
That, say now, for example, the earlier example I was talking about, right? They will give you the same rights. It's not going to be 1:4. It will be, say, for every one share, they will say, so for every 4 shares, not one share, they will say for every 4 shares, 2 shares or something like that. So you will not get diluted. But what happens is when you have more shares in the market, something called earnings per share will come down.
Oh yeah. Okay.
You remember something called earnings per share. What is earnings per share? The total earnings, profit
So
after tax, divided by the number of shares.
divide by number of shares. Yeah.
And that is something which you don't want it to come down very sharply. So more shares you issue, so the bigger the discount, more shares to be issued, more shares must be issued, what will happen is your share price, the earnings per share will come down. That is immediately that is what is going to happen. What is the second thing that is going to happen? Now you have not 100 million shares, now you have 120 million shares in the market. So if you remember the ordinary dividends are paid on the basis of dividend per share. So earlier if you had 100 million shares, if you are paying $1, you need only 100 million to pay the dividend. But now when you have 120 million shares, if you are going to pay $1, you need 120 million cash out.
Yes.
Right. So these are some of the issues where the directors will have to look at. So however the issue price is reduced, you need to issue a higher quantity to raise the required sum. Because ultimately idea is you have to raise a particular amount of money to do a particular project. Right? Maybe to do a film or maybe to do 10 films, you want to raise money. That's the ultimate idea. So you have to decide how many shares you want to issue and at what price the company wants to buy. We discussed underwriting. Remember, underwriting is whenever we come out with a rights issue, whenever we come out with a public issue, there is always a risk that all the people may not buy the shares. Now, particularly, you remember we discussed something called individual investors and institutional investors. Right? Now, in some companies, you might find more individual investors, like people like you and me. Now, people like you and me, we are not the people having money all the time in the world to invest in the company shares. Right? We have all our other needs and all that. So if you have many individual investors, when you come out with a rights issue, there's always a possibility that the people may not be subscribed.
Okay.
Even if it is attractive, even though it is attractive, people are not having money. So they can't buy. So in that case, there's always a risk of people not buying. So where we have more individual investors, it's always good to go for a underwriting arrangement. If you have more institutional investors always have money. They are looking for good investments. Like the pension funds, like the banks, they are looking. So if you have more institutional investors, they will be looking all the time to buy shares, and then there's a less risk of it getting undersubscribed. So there may be not a big necessity for an underwrite.
Okay.
Now placement, you don't need to underwrite because placement is something where you invite certain people. So they either buy or they don't buy. So there is no risk of something happening. So you don't need to. But when you go to the market, you have to be very careful because you can't say you want 240 million. If you have collected 200 million, you can't do anything. You are neither here nor there. You must get the balance 40 million. Right? So balance 40 million, if there are no people to buy in the public, the underwriter should buy. That's the risk always we had. That's why we go for underwriting. So I remember there was a question sometime back about in one of the F2 papers. It was all, they gave the shareholder profile. They told these are they had a big number of individual investors. And they were wondering whether to go for a rights issue. And they were wondering whether they should go for a underwriting. Right? So the idea is if you have many individual investors, it's always good to go for underwriting.
Right.
So even here, maintain, they might say they have many individual investors. In that case, it's a good idea to go for underwriting because the individual investors may not have all the money in the world to invest when they want. So selection of rights issue quantity will depend to a great extent on how much we want to raise, and then the board will have to decide at what price should we come to the market. 15 is the market price. Should we come at 12? Should we come at 12.50? Should we come out at 11? So once that is decided, they have to decide, okay, we are coming out with, we want to raise 240 million. We will come out at 12. So then it is 20 million shares. So they will have to look at the earnings per share and all that kind of a thing. And then once they decide 20 million, okay, existing 80 million, 80 divided by 24. So for every 4 shares, 1 new share. Now, one thing you have to remember is you can't issue fraction of shares. You can't issue for 2.5 shares, 1 share can't be a kind of a thing, right? Or you can't issue for 2 shares, 0.5 shares, you can't. You have to make it a whole number. So you have to, so in that case, it has to be for every 5 shares, 2 shares.
Right.
Something like that. You have to make it always whole numbers. You can't do fraction of shares. So it has to be, if it is for every 2 shares, 1 share, it's all right. But for if the formula comes, once you divide 80 by 26 something and 3.3 or something like that, you can't issue for every 3.31 share. Then you have to multiply all to get a full number. So for every 10 shares, maybe 3 shares, something like that.
Right.
So these are the things that you need to note always. So now I'm coming to a very important thing. What happens to the market price after the rights issue? Now rights issue happens like something like this, Veena. Today, on the say 4th of February, the board of directors might meet and decide they are going to come out with the rights issue. Right? And they say for every 4 shares that is held by any shareholder, there will be 1 new share offered at 12.
Okay.
I'm taking an example. So immediately once it is announced, it is not going to happen today. They will tell 4th of February, they will say the rights are opening on the 20 or March 1st. 1st of March, right? So till the 1st of March, the people who have all the shares there will be entitled. The 1st of March is the day that the people can apply for shares, or the people can apply from now onwards. But the 1st of March is the day that they will be allotted the shares. So immediately once it is announced, the company will say it's about a new project or that new film and all that kind of a thing. What will happen is there's a lot of uncertainty. And immediately the 15 market price will drop to some figure. It happens, remember, due to uncertainty, because the people are wondering why this company is coming out with the rights issue, right? What is the film, what they are going to do, all that kind of a thing. And from 15, it will drop to some figure. Right? Then, because the people will be looking at, future profits, future dividends, all that kind of a thing. Then comes the 1st of April, 1st of March, where the company issues the new shares. Issues the new share. So the moment the new shares are issued, again the share price will fall. So there are 2 drops happening. The day that we announce it, it happens because of the uncertainty, and after that it happens because there are more shares in the market. So that is what we are going to calculate, something called theoretical ex-rights price. Can you remember what is theoretical ex-rights price? After the rights are issued, what will be the theoretically the price? Now for the example that what we were talking about, let's assume that you have 4 shares, and for every 4 shares we are having, they are going to issue 1 new share. And let's assume it's at the moment it is 15. Let's assume at the moment it is 15, and they are going to issue new shares for every 1 share at the rate of 12. Now just before the just before the rights issue, the 1st of March, let's assume the market price has dropped from 15 to 1450. Why it is dropping? Because of the uncertainty.
Uncertainty. Yeah.
So now you have 4 shares worth 1450.
Hmm.
Going to 1450, 58 is your share wealth, your 4 shares. Now you are going to get one new share
Hmm.
at the rate of 12.
Okay.
Right? At the rate of 12. So now total value of your investment is 58 originally, 12 now, 70. How many shares we have now altogether? 5.
5.
Earlier
Yeah.
we had 4 and now 1, 5, so 70. So divide 70 by 5.
It's 14.
This is what we call the theoretical X-rights price.
Okay.
Theoretical X-rights price. Now what is the benefit that you have got, right? What is the benefit you have got? You got a share worth 14 in the market now for 12. You understand, right? You have got a share worth 14 in the market now for 12. True enough, you lost something from 15, it came down to 1450, all right. But on the 1st of March, the share price was 1450. But now you have 5 shares worth 14. Right? So you can see what happened. The one share you have got a benefit of $2 benefit here. This is what we call that value of that right. To get that $2, you have to have 4 existing shares.
Okay.
Right? So if you look at from an existing shares point of view, for every share what you had, you have got a benefit of 50 cents. Right? $2 is the total benefit what you got on the new share, and to get that you have to get a benefit, you have to have 4 shares. So this is what we call the value of right. So you have got a benefit of 50 cents for every share you hold it. This is what I told you, you can sell it. That 50 cents you can give it, you can sell it to me. You may not want to, I may not want to buy the entire 50 cents. You might share with me 25 cents, 25 cents. So you get a 25 cents. Without taking any rights, you will get for your 4 shares 25 cents into 4, $1 into your pocket. And now look at the calculation, right? You have at the moment how many shares? 4 shares. You are not going to buy the shares. You are not going to buy the right. You don't have money. You are going to sell that to me. So when you sell it to me, I pay Veena 25 cents for the rights. So for your 4 rights, right, I pay you $1. And I can buy from the company because now you have given me the right to buy for $12. So what is my cost? I paid you Veena I paid for Veena $1. I paid for the company $12, 13. What is my benefit? My now share is worth 14.
14, yeah.
Right? So I have got a benefit of 1. And you got a benefit of 1, right? You did not buy the shares, but you just got $1 into your pocket. So that is how that $2 that we have shared.
Okay.
That's the benefit we have got. Now, if you have bought the share, if you have bought the right, what will happen? If you have bought the right, you will have your same rights happening, no problem with the right, and you will have 5 shares worth 14. Right? What has happened to your wealth? Look at your wealth, what has happened. Right? Earlier you had 4 shares into 1450, 58. Now you have 5 shares worth 70. Okay, 5 shares worth 70. But you have to spend out of your pocket to buy that 1 share, $12.
Okay.
Right? So what has happened to your wealth? By taking the rights issue, has your wealth gone up, gone down? Same, remain same.
Remain same?
Remain same. That is what is happening with when you take the rights issue. Now if you have sold me the rights, what would have happened? Now you have only 4 shares. What is the new market price? 14 into 4?
40.
56.
56, yeah.
56. plus the $1 you got into your hand, you have only 57, right? So you have lost little bit. Your wealth had got reduced. Earlier, originally it was 58, but now it is 14 into 4, 56 plus 1, 57. If you did not sell and if you just ignore the rights issue, then you did not get any money into the pocket, but you have 4 shares worth 14 into 4, 56. So you have lost $2.
Yeah.
Right? So if you don't do anything with the rights, you lose some money, you lose your wealth, and you lose your interest. If you buy the rights, you don't lose your wealth will remain same, and you will have the same control also. If you sell your rights to another party, you lose wealth, but not to the extent of the earlier scenario, but you will lose your the controlling interest.
Okay.
So you can see what happens. The 15 was the market price just before the announcement. It came down to 1450 because of the uncertainty. And after that, theoretically, it will fall down to 14 because that's what we call the theoretical exercise price. So this may be an area that the examiner want to test you. They might ask, Veena, we are thinking of coming out with the rights issue. Can you explain what will happen to our share price? So it has a two drops. One immediately with the announcement, mainly due to the uncertainty. Secondly, it drops after the rights issue, mainly due to so many shares in issue. Now it is we have 5 shares in the market. Earlier you had only 4 shares, and also shares were issued at a discount. It was not issued at the full market price. It was issued at a discount, and for those 2 reasons, it dropped.
Right.
These are the things that you need to know, because it's very unlikely there will be calculations, but you need to know what happens after the rights issue.
Okay.
So this is just after the announcement from today onwards, from 4th of February till the 1st of March, whoever who is holding those shares, Veena, who is 4 shares, is entitled for a 1 extra share, and that's what we call cum rights, cumulative of rights. Cumulative of rights. So from today till 1st, whenever you sell your shares, you are selling with the rights.
Okay.
Selling with the right. And immediately on the 1st of March, when the shares are issued, the new shares are issued, it becomes X rights, excluding rights. So today, if you go and sell the shares, I being the new shareholder, I'm entitled for the rights, not you.
Okay.
That is what is happening. So that's what we call the cum rights and X rights. So this is the formula. We don't need to worry too much about the formula because no calculations are necessary in our exam. But I showed you how to get that theoretical X rights back. So this is an important one. What are the implications of a rights issue? So from Mentin's point of view, what is the implications? What if the implications from a shareholder's point of view? So your board of directors might ask, Veena, we want to go for a rights issue. What are the implications we will have? So surely it's a very simple way and a very cheap, very easy way to implement. Generally, it will get fully subscribed because the people, our shareholders know our company very well, and therefore people will buy shares. And also, when you come out with a rights issue, it is a signal to the market that the company is growing. Company gets a lot of publicity because the company will have to say why they want to raise money. So they will say we are raising money, to do another 2 films. So it takes it immediately enhances your profile and says the company is doing very well, they are going for growth and all that kind of a thing. So that kind of a publicity comes up. So it's a good way to raise money. What is the implication from the shareholders' point of view? They have the option to buy shares at a preferential rate, at a cheaper rate.
Yeah.
They have the option of withdrawing the cash by selling their rights. Now all this time, Veena had the 4 shares, but Veena never had the opportunity of selling the rights and collecting money. But now you have got a blessing coming up. You can sell that blessing and collect some money. Keep in your 4 shares. Of course, the 4 shares price will come down, but still you will have the 4 shares. right? And by buying the shares, buying rights, they will be able to maintain their existing relative voting position. So these are the, so this slide is a very important one for the case study whenever we are looking at a case study. Basically, that's all about the share issue. So now we are looking a little bit about the debt finance. So you remember I told you debt finance, if a company borrows money, whether the company has profit or not, cash or not, the directors are under obligation to pay interest on time and to pay capital on time.
Yeah.
Dividends, the directors are under no obligation to pay dividends, and the shareholders cannot go to courts and demand for dividends. But lenders, they can go to courts and demand for AI interest. And interest is an expenditure. Dividend is not an expenditure. Interest is paid before profits. Dividend is paid after profit. And therefore, interest is tax deductible. Dividend is not tax deductible. So there is always a risk for the shareholder directors by borrowing money. If the things fail, they have a big burden, responsibility. Still, they have to pay interest. So, company like Maintain, where the business is somewhat risky because they do not know till the film is produced how the film is going to be and all that kind of a thing. So, for a company like this, I think it's good for them to go for equity finance as much as possible.
Right.
That's a way to go forward rather than, unless they are very 100% sure of the film, in that case, of course, they can go for loan finance. When you are going to borrow money, you have to give some security. That is what we call, say, mortgage over a property or something like that. Now, being a film company, they may not have, if you see their balance sheet, I think they have in too many properties. So they may not have enough properties to use. So that may be one problem that they might have it. They might not have all the properties in the world to be given for the bank loans, etc. So that could be one of the issues that they might have it. Yes, money. Already they must have given already for banks, whatever, because they raised 1.5 million. So they might not have. So going for loans, always you have to use security. Balance sheet and see whether they have anything. See, they have very little property, plant and equipment. That's all. 28 million is the asset. So they don't have too much of room to raise money on bank loans, keeping security. But their monies are invested in investment in films, and that's their big item. So,
Kumar,
yeah.
Can Maintain for getting the money through banks, can Maintain give the library, the online the library content that they have on as a security?
They can, but will the bank accept it? What can the bank do with the films in the library?
Right. Okay.
You know, understand, the security must be something what the bank can, in the event of a default. Why do we take a security? In the event of a default, the bank can go and sell it. Right? Now, building, if they give it, they can go and sell it.
Right.
But the films what is in the library, they can give it. But very unlikely they can sell that one.
Okay. Right.
So that is why actually there are two types of securities. One what we call fixed security. The other one what we call floating security.
Floating security.
Now they might be able to get a floating security on their receivables. They have some receivables to receive, 874 million. So if in the event of a default, fixed security means it's fixed. It's like something like a building, it is always there. Floating security means something like receivables, it is changing. Today, Veena owes money to the company. Tomorrow Kuma owes money to the company. Today it's 874. Last year it was 867. Day after tomorrow it can come down to 400. But
Okay.
the court, if it's a floating security, if the company defaults, the court will order to settle that loan out of the floating security. So all the receivables money will be collected and paid to the lender. That is what happens. So, but investment in films, very unlikely it will be of a useful tangible asset or a kind of a security for the bank.
Okay.
That is what can happen.
Right.
So, yeah. Basically, security charges, it can be a floating charge, it can be a fixed charge. The fixed charge is more secured, but these people don't seem to have. So you have to be very careful when you're suggesting something. They might ask, can we get a bank loan, Veena, keep in our property plant? What property plant and equipment? We have only 20 odd million. Right? So we don't have too much of scope to raise money.
Okay.
Right. Already we have got 1,500 million. So surely they would have got the 1,500 million either from a bank, most likely from a bank, because they are going to pay 300 million or something like. No, this company, did they have a bank loan?
It only says loan.
Loans, no?
Yeah, only loans.
Yeah, loans. Yeah. Sorry. Here, when they say loans, we do not know what it is. But it was 340, it had gone up to 350. But then we have another loan called film obligations and production loan, 584 to 620. So there are a couple of loans. We do not know whether they are bank loans or whether they are bonds or anything like that. But whatever it seems, they have got some loans at the moment.
Right.
And most likely their loans are not secured. Right? Not secured because they don't have enough property, plant and equipment to be given anything. They have a big intangible of a goodwill, and the other one they have is the films. So they don't have too many assets to go and ask for bank loans.
Okay.
So whenever we take loans, we have to be mindful the banks or the lenders can put certain restrictions on us, on the directors. That is what we call covenants. The covenants will say you have to maintain a certain financial ratio. Gearing should not go above 40%. Dividend should not be paid more than $2 per share, something like that. Every quarter you have to provide annual the financial reports. You can't issue further debts. All that kind of many rules and regulations can come up, and that's what we call debt covenants. So it can, it can keep your hands somewhat tight, bind. The company may find that they have a good film to go through, but they can't because they have got some debt covenant. Now this is the advantage by going for equity finance. Equity finance, there is no conditions attached. Directors are free to do whatever with the equity finance in the way that they want it. So they have a fairly good freedom with the equity finance to go to. There are certain negative debt covenants saying you can't do this, you can't do this, you can't do that kind of a thing. And there are maybe what we call positive debt covenants saying that you must do these things. You have to maintain this ratio, you have to maintain accounting IFRSs, you have to provide audited financial statements, all that, everything. Covenants are not bad. The implications of a covenant, this is something I want you to understand, the impact of covenant. For the lender, it brings some kind of a security, right? It restricts or it restrains the borrower from doing something too risky or unnecessary thing. For the borrower also, it's a good thing. It brings some kind of a financial discipline.
Right.
Because you can't do everything what you want to do. I was working in a company where I had a crazy managing director. Every time he wants to do something really risky, buying vehicles and doing all sorts of expansions, all that kind of a thing, the only way I could prevent him by doing whatever that he wants to do was by getting the bankers to put certain covenants. So every time whenever he says, I say, very sorry, we can't do that because the bank has put a covenant. Otherwise, he was really good. So it brings a lot of financial discipline to a company, and in a way, it's a good thing, right? But the idea is not to place a burden on the borrower, but to make him disciplined. That's the idea of a covenant. So you might have a case study question coming up here. You want to go for a bank loan, and the bank is putting certain covenants, and the directors might want to ask Veera, Veera, should we go for this one, right? Because these fellows are putting all the covenants, should we go for it? So your answer will be, it's a good thing to go with covenants so long as it's not a burden on us, because it will bring a lot of financial discipline to our company, and it's a good thing to go with the covenant.
Okay.
Whenever we want to select the type of debt, now this is very important for a film industry, we must see the time scale. You remember, always we have something called a matching concept, that if the film is for 3 years, production and everything is for 3 years, we need funding only for 3 years.
Yes.
Don't take funding for 5 years, because what are you going to do after 2 years? You have to pay interest without any investment, right? On the other hand, if the film is going to be produced over 3 years, don't take funds for 1 year, because after 1 year you have to repay the loan, and how are you going to do the balance part of the film? So time scale is very important. Obviously, the cost is very important, how much interest you have to pay, and also liquidity. Liquidity means what is available in the market. What is available? Sometimes the bank loans are available, sometimes the shares monies are available. It all depends on the country's economy, country's financial policies, monetary policies. So all those things will come into play when you decide to go for various loans, etc.
Okay.
Now, one thing, I don't think it will be very relevant here, but maybe, they have some short-term need of funds or a short-term excess of funds. This is what we call money market transactions. You can go to the money market. It's a big international market. You can just invest your money on a short-term basis, or you can borrow money on a short-term basis. Generally, this is what the banks do. At the end of each transaction day, one bank has to borrow from the other bank, and in London, when it happens, they charge the interest, and that is what we call LIBOR, London Interbank Offering Rate, Bank Offer Rate. That is between the two banks, the rate in London is what we call the LIBOR. It is the best possible rate, the cheapest rate, and generally international transactions are based on LIBOR. But this kind of borrowing is not available for you and me. It's available for large companies. Maintain may be entitled for this kind of a thing. Remember, Maintain is one of the largest companies in Europe in the film industry. They might say, Veena, we want some money just for 4 weeks or maybe 2 months. Where can we go? So it's silly to go for a share issue, silly to go for a bank loan. It may be an opportunity where we have to go for the money market borrowing and to look for some money there.
Right.
Then we have what we call revolving credit facility. Now this is very good for a company like ours, Maintain. It's like overdraft, but it's a big one. Now you and I, we can have a bank overdraft. If we have an overdraft of say $5,000 or 5,000 pounds or whatever, today if you use $1,000, they will charge interest only on the $1,000. Right? Tomorrow you settle $500, they will charge interest only on the $500 what is outstanding. Day after tomorrow you take another $2,000, it goes up to 2,500, they will charge interest on the 2,500. So it is only on the value utilized they charge. Up to 5,000 you can use your facility. Similarly, a company like Maintain, they need always facilities, and they can have what we call a revolving credit facility, a big overdraft kind of a thing. they pay interest only on the amount they use it. Now, if we take a loan of 50 million, whether we use the entire 50 million or not, from day one, we have to pay interest on the entire 50 million.
50 million, yeah.
But if we get a revolving credit facility of 50 million, you use only 10 million in the first month to pay your actors advance or whatever, you pay interest only on the 10 million. Next month, it goes up to 15 million, you pay on the 15 million. That's all. So that's a big advantage. So this is a good facility for a company like Mentine to look for something like a revolving credit facility. So this is a kind of a finance what you can suggest for a company like Mentine, because their monies are always coming, going, coming, going. That kind of a thing. RCF facility is a very good one. And sometimes, normally, when it's a very big amount, many banks will get together and give the facility, and that's what we call a consortium or a syndicate.
Okay.
Capital markets, you can go to the stock market, and company like Mentine can issue bonds, and bonds are which basically where you go to the market for long-term loans. You promise a particular coupon rate, and you have to pay the coupon rate, and you have to borrow money. You can borrow money. No need of any securities or anything like that. Generally, they are very long-term, and that's a way for you to get some kind of a permanent loan facility on which you can pay interest and keep on paying. Difference between shares and bonds are also tradable in the stock market, shares are also tradable in the stock market, but bonds are redeemable, shares are not redeemable. That's the big difference. Of course, preference shares are redeemable, but normally equity shares are not redeemable. This is another one which I can think for a company like Mentine, what we call a commercial paper. These are big companies. They can come to the market and issue something called a short-term instrument and raise big money for about 9 to 10 months kind of a period, right? And now say they want to raise 100 million, they might come and issue 1 million commercial papers, and Veena has money, Veena will buy one commercial paper for 1 million. But it is for 9 months. But you don't need to wait for till the 9th month. You can go out to the market and sell this on another day, maybe for 1,010,000 or 995,000. They are marketable securities. So, company can raise big money. There will be big investors who buy the commercial paper. Generally, it's not less than 1 year. So, this is another kind of a thing that is available, just like money market, a commercial paper for large companies they can issue. The money market, it's a transaction. It's a closed-end transaction. You have to pay to the lender, but here you buy a 1 million commercial paper, you can sell it tomorrow. You don't need to hold it for 9 months. That's the advantage. I will buy it and I will keep it, and I will get the interest, whatever.
Okay.
Generally, in the capital market, we have the issuers, that is the people like the Mentine who will issue loan instruments and collect money. Then we have the purchasers, the people are individuals, institutional investors, all those people who will buy the things. And underwriters is the facilitator. This is not really something we need to do calculations, but something called irredeemable debt. So there are two types of debt we are talking about. One we call redeemable debt, one we call irredeemable debt. Now, any debt is redeemable technically. But what is meant by irredeemable debt is you take 100,000 and you are settling 100,000.
Okay.
Right? It's like a bank loan. You take 100,000, you settle 100,000. But when you go to the bonds market, sometimes you might sell the bonds at 95, issue price is 95, saying you will redeem it at 100. Issue in price and redeem in price are two different ones. That's what we call the redeemable. So you have to remember whether it's now these are very misleading terms, because when they say irredeemable debts, you might think debt is irredeemable. No, all the debts are redeemable. What the difference is, irredeemable debt means the issue price and the settlement price are same, like a bank loan. Redeemable means the redemption price is different from the issue price. Issue it at 95, redeem it at 100. Issue it at 105, redeem it at 100, something like that.
Okay.
So that's what it is all about. So there's a calculation on the interest on the redeemable debt. That is what we call yield to maturity. That you don't need to know the calculation, but just remember it is working on the internal rate of return method. So
right,
we have finished up the big area on the long-term finance. You would have seen most of what we discussed could be applicable to this company. I believe one of the variants will be in raising money, because this company needs money for expansion, and there has to be some kind of a way for them to raise money. So I believe it can be very useful for you, and you know, all what we did. So I said I will share the slides with you, and just go through these things. I will send the recording also. Go through these things, and when we meet on Wednesday, we will again shift back to our marks. And as you said, we will look at some transfer pricing also.
Okay, fine.
So we are meeting on Wednesday at 4 o'clock, I think.
Wednesday 4 o'clock.
Yeah,
yes, yes, we are.
Okay. So I'll see you on Wednesday 4 o'clock, Veena.
No problem, Kumar.
Yeah.
Okay.
Keep writing some of the answers. Go through some of your revision work and see whether if you have any problem, just send me a mail.
Okay, sure, I will, yeah.
Okay, thank you. Take care. Have a great weekend.
Okay, Kumar.
Bye.
You as well.
Bye.
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 Enjoy the video. Bye. Bye.